Hello and welcome to episode 17 of the Wealth Amplifier podcast. I'm joined today, as always, by Aaron Marks and Pat Swift. I am Matt Liebman, and it's just the three of us today. We have a special guest coming up on our next episode, but just the three of us. So, hello, gentlemen.
How are you doing? How's everybody doing?
It's a good day.
Good.
It's, you know, everyone will hear this a few days later, but March Madness week. It's an exciting time.
Yeah,
it's true. The opening weekend, though, I do wonder. It feels like it is declined a lot in popularity over the last few years. I mean, the tournament's still good, but like, I couldn't tell you who half the teams are. I know UConn's good, but I feel like I haven't followed much this year.
I also think Selection Sunday used to be a thing,
mm-hmm.
and not so much anymore.
Yeah. No, I guess, any number of reasons that could be, but I imagine the dearth of NBA top picks that seem to be in college these days might be a factor.
Yeah.
But anyway, that is not the amplified topic of this episode, though we can talk about it. Today, in light of the fact that we are in, let's say, mid to late March here, the topic we're going to discuss today is the always fun topic of taxes. Essentially, why do they matter? What are some planning related strategies around taxes, some investment considerations when it comes to taxes, and then how politics plays into the investment and planning side of taxes. But before we dive into all of that, why don't one of you sort of take it away with why taxes matter from our day job's perspective, and more importantly, from our clients' perspective?
Do you want more money in your pocket at the end of the day or less? And that's it.
All right. That's the episode. We'll wrap it there.
See you later.
Yeah. Well,
Go ahead, Pat.
No, you're right, Aaron. I think it's most people think of taxes this way, but they don't always phrase it this way. Is for most people, most of the time, taxes are your biggest annual expense, aside from maybe your housing cost, and they could always be that way. That might always be the fact. And similar to any expense, you want to reduce them so that you have more free cash flow, ability to save, all that fun stuff, but almost not in a vacuum, right? We'll get into it a little bit, but similar to when you make an investment in something and you have to use capital to make that investment, sometimes taxes can be looked at as that way. You pay more taxes now to maybe pay fewer taxes down the line. We'll talk about all of that, but generally speaking, they're your largest expense. So there's something you should be planning for and strategizing around.
And it's also one of the things that I don't think everyone factors into the equation of I don't want to say active. We are active managers of portfolios, but a lot of times actively managing passive investments. I don't want to say actively managing like buying and selling stocks all day, but sometimes people will say, I'm just going to put money in the S&P 500 and call it a day. Let's say not IRA. So we're, a regular old joint account. I'm going to call it a day and never have to worry about it. But if you do that, taxes could be an issue down the line. So why not actively manage that? Break that S&P 500 fund into 3, 4, 5, 6 funds or different pieces, and leave yourself a lesser of a tax bill. And I'll let you guys elaborate in case people are wondering on what I'm talking about. But yeah,
well, I think that's a good segue to some of the common tax topics and strategies that we deal with on a day-to-day basis. So, Pat, do you want to lead us off on some of the planning related tax topics, and then we'll get to some of the investment ones, which is really where Aaron was going there on some of the more tax efficient investment strategies that are out there.
Yeah, sure. I mean, broadly speaking, as I raise my desk up here, hopefully didn't mess up my the YouTube video at all. But yeah, nowadays in the environment that we're in, I think it's worth amplifying. We do a lot more around tax planning for clients. We have the ability to do a lot more to review clients' tax returns and integrate it into their overall financial plan. But yeah, I mean, generally speaking, from an investment standpoint, we look at things like the use of tax location and retirement accounts, using Roth IRAs, deferring and moving money into Roth IRAs. a la backdoor contributions or Roth conversions or some combination of the two. We look a lot at what types of deductions people are taking. We look at how tax efficient their actual investments are performing, like Aaron was alluding to a little bit. All those are topics that we provide a ton of sort of proactive framework around. What do you guys want to start with? What should we dive into?
Why don't we start with the basic concept of deferring gains versus realizing gains in the here and now? You're sitting there. As my dad told me when I got into business, any gain is better than any loss. You still want to make money. But if you've had the good fortune of seeing your portfolio value go up, why don't we talk about just sort of the basic concept of, do I realize that profit now, or do I defer that gain, and what makes the most sense, and how do we think about that when we're talking to clients, usually around the end of the year? Though I do think, to Aaron's point, good active tax management should be a year-round endeavor, not a let's scramble on December 15th endeavor.
It's a good point. I think I don't think there's one a one size fits all answer, which is why having good conversations and proactive planning with the right people is important. Because if you're looking at deferring versus realizing gains on a spectrum, the right answer probably isn't never take gains and always take gains. It's probably something in the middle. I know we've kicked around a lot of different strategy and a lot of different theory internally about how we think about those things for clients. But I think, and Aaron, I'll kind of bring back what you were just mentioning about, okay, if you own an S&P 500 fund or a mixture of a bunch of index funds for 30 plus years in a one-way investment street account, like we always talk about, right? Guess what? You're going to get to age 60, 65. You got a tax efficient, hopefully, withdrawal strategy. But that means you're taking gains to withdraw your money every single time, hopefully, if your investments have performed well. And we talk about this a ton. Now you're going to have a tax bill every single time. Might not be the most efficient way to do things. You also might be a little paralyzed by that tax bill and say, oh, I need money, but I don't want to pay these capital gains. So what do? I think we have talked a lot about, you do something every year, right? Maybe you don't take a bunch of gains in a year where your investments are down, like we tried to avoid in 2022 for clients, but you should probably take gains along the way, reset your basis, so that your tax bill, when you do get to age 60 or 65, you're withdrawing money, you have hopefully losses that you've carried forward. You've got gains that you're taking. You have lots that you can take from that do not have major capital gains. I think it's a mixture of those two is where I think the three of us have rounded out our philosophy. I don't know what you guys want to add to that, though.
Yeah, you mentioned it already, and we have referenced this several times in previous conversations. It's just being paralyzed by huge gains, whether it's an ETF, a mutual fund, an individual stock that you bought 100 years ago, or where a company where you worked. If it really works out, it's great. But you get to the point where like, oh man, I don't want to sell now because I have just a massive gain. So what do? You don't sell. You wait to the next year. It goes up more. You're more concentrated, more risk of something blowing up, and then a bigger tax bill. So if you don't get ahead of it and trim, you prune the trees, prune the bushes so it's healthier and then it can grow again. You don't just let everything get overgrown and now you're stuck under a giant tree with a lot of gain. It's all good, but a little more manageable.
Well, first of all, I think your new podcast nickname needs to be Captain Metaphor, because no one draws it in better than I was hoping you were going to bring it all into some sort of hoagie type scenario there.
Saving that for later.
Fair enough. I think it's sort of an interesting. I hope this isn't a sign of a market top, but an interesting thing that the podcast topic is the champagne topic of what do you do when you have massive gains? But that is the reality now. A lot of people do have massive gains, and I don't think we're excluded from that conversation, thankfully. So I do think my general experience with human nature when it comes to taxes is people always want to put it off. They always want to defer. And a lot of times that's the right call, by the way. Sort of time value of money, deferring taxes is not a bad strategy if you had to default to one. However, Pat, to your point, it's not one size fits all. There are times where it actually makes more long-term financial sense to recognize more gains. And just to sort of keep that conversation going there, can you address a little bit, either one of you, whoever wants to take it, this whole idea of traditional versus Roth retirement accounts, which really play on this idea of deferral, taxes now versus taxes later, and sort of the offshoots to that, be they Roth conversions, backdoor Roths, that type of stuff.
Go ahead, Patrick.
Yeah, I mean, on a really basic level, traditional IRA assets are those that have yet to be taxed, not exclusively, but for the notion of this conversation, let's just assume they are.
Right.
So they're dollars that you would get a tax deferral on now. So if you are putting money into a traditional 401k, you are not paying taxes on the savings that are going into those. You're paying some FICA tax, but you're not paying your federal and state taxes on those. And you're deferring them until when you take withdrawals out in the future. And in the future, they'll be taxable as income to you at that point, hopefully after they've grown quite a bit. And then with regard to Roth assets, it's the opposite. So you're going to pay your income tax on those savings today. They're going to grow for you the same way they would in the traditional sense. But when you take them out in the future, you're not hopefully, as long as you check a few boxes, paying any income tax on them either. So the idea, I mean, I think that the traditional idea, no pun intended, in our society in the US has been, in your working years, you're going to be in a higher tax bracket. You're earning income. Your tax bracket is higher since we're in a progressive tax system. And when you get to retirement, you'll have less income. So you should be in a lower tax bracket. And traditional has made sense. I think some of that logic, especially in the resume that we'll talk about too in a little while, the tax system that we're in right now has flipped that script a little bit. I don't think it's as much as a slam dunk to think that as much anymore. And there's also sorts of additional benefits to having money in Roth accounts, not least of which is just psychological. You don't have to pay taxes when you take the money out of the accounts, which is a nice feeling for most people. So if you guys want to elaborate on some of the additional benefits of Roth accounts and why we often, not exclusively, but we've pounded the table about, getting more money into Roth accounts for clients over the last many years.
Well, let me give you a very basic, non-economic but behavioral Roth IRA example. It's not really an example. It's just sort of an experience, which is you can make, and I, by no means am I belittling the economic and mathematical financial planning work that we do, because I think it's amongst, if not the most critically important thing we can do. That said, no matter how you model things, no matter how you look at it, I have yet to meet a 60-year-old client who's really angry they have too much money in their Roth. I have met some that are disappointed that I'm a little too tilted towards the traditional. That doesn't mean that you should just turn around and put all of your money in a Roth tomorrow. There are consequences to that, and it may not be the right call. But I think you're right, Patrick. I think I do tend to err on the side of, all else equal, the more money you have in a Roth, the better your financial plan's probably going to look in the long term.
And it's a lot more of a slam dunk when you're earlier in your career, when you have all those, pay the taxes when you're 25 and 30 and 35 years old. And now you get to make up that tax bill in that Roth IRA for decades upon decades. But it does still make sense sometimes when you're in that highest tax bracket, and we model it out using software. If I'm in the highest tax bracket now and I'm going to retire in 10 years and I'm going to be in that much of a lower tax bracket, well, maybe you still have some business income, and you're a dual income family and you have $90,000 of Social Security and all these dividends and interest. So you're not going to be in a low tax bracket, but it still makes sense. And how about for your kids? Some of these rules are a bit in limbo on how fast beneficiaries might need to take money out of Roth and IRAs when they inherit them, non-spouse beneficiaries. But in the IRA, children will have to pay the tax bill when they are forced to take money out. Roth, the bill has already been paid. They're still forced to take money out, but now better for the kids. So there's other benefits, obviously the psychological, the tax benefit down the road, beneficiaries, it just goes on. And the Roth is a really powerful tool that we yes, like Pat said, we really have been pounding the table on.
Yeah, it's a powerful tool too. I think if you look at the current generation that's retiring and will be retiring for the next handful of years, baby boomers, demographically, they hate spending money. Like if you look at the trends of baby boomers, a lot of them have been great at saving money. They've had great economies leading up to retirement that have allowed them to grow their accounts. And what you just said, Aaron, often sounds like music to their ears, where it's like, hey, based on your retirement plan, you're going to have a pretty large estate unless you start spending more money, but you just can't get them to spend that more money. So, okay, great. You're not going to need it during.
Hold on. Is that stereotypically true? Baby boomers don't like to spend?
I think generally speaking, there is quite a bit of research in our country that
See,
baby
I always
boomers.
thought they were like a higher consumption generation. I guess I got that wrong. I did not carry on. You're educating me here.
And I'm sure there's some nuance here, but from some ancillary and some research I've seen, there's that whole baby boomer sort of wealth generation shift is going to be large because traditionally they don't spend a ton of money. So the idea, to your point, is Aaron, is pound the table about the same thing. But if you can then give that same money to your heirs, to your beneficiaries, your loved ones, in an even more tax efficient way that you were going to give them anyway, yeah, pay the taxes on it during your lifetime if you want to be all that more generous. So even more reasons to have money in Roth accounts to give yourself the flexibility. So yeah.
And I think, we could have probably, and maybe we will later in the year, a whole podcast on Roth conversions and Roth IRAs versus traditional. And we haven't even gotten into some more advanced planning concepts that we talk about, or things around estates and gifting and so on. But I guess in the interest of keeping us moving and staying in our normal time frame here, why don't we talk about some of the generally speaking, tax efficient investment strategies that are out there. I'll throw out the first one. Municipal bonds. I feel like bonds. Maybe I'm throwing out the first one because bonds are relevant for the first time in 15 years, so I'm happy about it. But essentially, general idea. There are exceptions to this, but most of the interest on municipal bonds is federally tax exempt. That is, you do not pay income tax on that, and sometimes state and local as well, depending if you're buying bonds in your own state. And there are pros and cons to that. And there you just have to weigh the pros and cons of that. After I have seen times where people take it too far, where they say, I'm a muni bond investor. I just want to be a muni bond investor. And as an aside, and I've made this comment before, I think a lot of times that is for cocktail party reasons, because muni bonds have always been sort of the domain of the wealthy people. So I think people want people to think that they're wealthy. So they'll say, I'm a muni bond investor. Sometimes they are, sometimes they're not. There is some cachet associated with it. But putting that to the side, there is the general idea of everybody likes tax-free income. That said, there are times when even after you take the taxes out of a taxable bond, it can still be a better investment. So you still have to consider sort of after tax risk reward, but municipal bonds are one type of more tax efficient investment strategy.
You might see me smiling on YouTube, and it's because I think we're all picturing the cocktail party person that's telling you about the 7% tax-free muni that their broker sold them, and they forget to tell you they paid $114 for it,
right,
rather than par of $100. But yeah, No, but look, it's popular. Like where rates are now, it's appetizing. You're getting great yields. You're not paying tax on the federal side. And we'll see where rates go from here. But yeah, they make sense again, as opposed to 5 and 8 and 10 years ago. Rates are at 2%.
Yeah.
Not as exciting.
100%. I think the only thing I'd add on municipal bonds, I think of them as the same way I think of any asset class of investments, is they have a fit for a portfolio if you have a fit for that asset class, right? If you're a rich person and you have you're looking to alleviate taxes, but you still are looking to grow your portfolio aggressively, you probably don't need municipal bonds, even if they're giving you tax efficiency. If you do have a place for bonds in a taxable portfolio and you also are in a certain tax bracket, then sure, they can make sense. And I know we have a couple of very accomplished investors, one of which is on the podcast here, that is very good at understanding the merits of when it can be great to get into municipal bonds from that perspective as well. So that's all I would add, is they make sense, but not as, like you just said, Matt, not exclusively as a tax reduction vehicle, but as a part of your portfolio allocation for investment reasons.
Fully agreed. And so let's shift to a different asset class. And this goes a little bit to what Aaron was talking about sort of at the outset. The idea of indexation, but now there are new ways to do indexation that may be more tax efficient. So Aaron, you want to talk a little bit about some of those strategies?
Sure. So just when I mentioned before, you buy the S&P 500, it is one unit. It is one ticker symbol. It goes up and down, and you have that full gain at the end of the day. If you took that 500 stocks out of the S&P 500 and bought each of them individually, at the end of the year, if the S&P 500 was up 10%, your portfolio, if you weighted it the same exact way, is up 10%. But inside the 10%, this one stock might be down, $1,000, and this one might be up $1,000. So your total return's the same, but now I can sell that one that is down for 1,000, take that loss, use it to offset a gain, on that other 1,000. So yeah, where we mentioned leaving more money in your pocket at the end of the day, if you can break your portfolio up, it doesn't need to be across 500 pieces, but 2 is better than 1. Maybe 4 is better than 2. Enough so that you can have diversification. It doesn't get overbearing to manage. Now, I'd love for every single thing that we ever buy to go up, but it's just not going to happen in a well-diversified portfolio or not diversified portfolio. So use that to your advantage and take that loss to offset those gains. And as Matt was mentioning, there are a bunch of asset managers and companies that we use that focus on tax loss harvesting strategies by replicating an index or an index that we design, not just an S&P, but to say, hey, I want to tilt towards US over international and large cap over small cap, but value over growth or what have you.
Yeah, and that general product area that you're speaking of is, what's called direct or custom indexation that's out there. And to your point, it's been a real hot growth area in the money management industry. It's almost the natural iteration. Indexes really started, in terms of gathering assets, give or take 4 decades ago with Vanguard and the traditional mutual fund, 2 decades ago, the ETF. And now we have, I think we have more ETFs than we have stocks. And then the latest iteration is let's own at least a sample of the underlying components of those indexes so we can more actively tax manage there. And there's even a later iteration that I won't go into here because we're still researching it that may be even more advanced than that. And we'll see if on conceptually, it has a lot of benefits, but we sort of have to get under the hood a little bit more.
Well, so and I'll just mention because I'm imagining clients out there listening to us right now saying, "Well, that sounds like a great idea. Why don't we do that? Why doesn't every single client in the world do that?" And the answer is it's really just not that simple. It gets a little bit more complex than we probably need to get into in this conversation. But if you keep it very simple, if you add a portion of your portfolio to a direct indexing strategy like that, and then let's say you did it January 1st, 2023, and you're sitting here in March of 2024, you don't have a whole lot of losses to choose from any longer. And as a result, now you're paralyzed by the same exact issue you were trying to solve for, which is you have nothing but gains. And it has sort of been this sort of permanent rebuttal against direct indexing that the 3 of us have tried to solve internally, and we have not come up with a perfect solution for it. It may be that there is no solution for it. The asset money managers will tell you just keep adding money, which is a viable solution to the strategy.
Sure.
But in theory, it is not as perfect of a solution as it sometimes is made out to be for what it's worth.
And I've heard that phenomenon recently referred to as portfolio ossification. So keep that on your radar. We are looking to solve for ossification. So I think we, just in the interest of time, should probably shift to the more evergreen part of the podcast, unless either of you have anything else you want to say for this podcast on taxes.
Not at all.
Nope.
You're done with taxes. All right, good enough. All right, Aaron, take it away. You're the evergreen guy. We got a couple different ways you could take us here.
All right, we're going to start with one article. This one is just from a couple hours ago. I don't pay for the subscription to actually read the article, but I don't need to read the article. I know very clearly what it says. Little scary, maybe, guys. BFA survey. Wall Street optimism on stocks is at its highest level since early 2022.
Do you think
Run
they're?
and hide. No, go ahead, Pat. Sorry.
No, I was just going to say, do you think they're referencing the bull bear indicator from B of A?
It could be that, that it's not was that contrarian one, Matt. That's a different one. But no,
The
I think
sell side indicator.
sell side indicator. This one, I believe, it's just individual investors. Are they bullish or bearish right now? And usually, when everybody's optimistic, it's usually a time not to be. So yeah.
So for what it's worth, I'll kick off if you don't mind, Matt. I think
Please.
for what it's worth, like any headline, I take it with a grain of salt or sugar, depending on what it is. But if it is referencing that indicator, that specific indicator, that thing, and I don't have the numbers in front of me, it's been somewhat reliable, at least in the short term. I think and I know this because the three of us were once employees of the firm, so we actually had access to that indicator on a regular basis. But I think from a scale of 1 to 10, it basically says if it's a 1, buy, if it's a 10, sell, and depending on where it is in that, that's probably what it's referencing. So I think it's worth noting where that is, just because it does tend to have a little bit of a good, I guess, sentiment indication. But I think that's all it really is at the end of the day. Is you could ask any three of us without looking at that indicator how we feel about markets right now. And I think we would all tell you something similar: is certain parts of the markets have gone up quite a bit very quickly, and I'd be a little bit cautious about that. And I think the indicator is probably saying basically the same thing, right?
Yeah, I think that's right. Like, there's no one, I don't think, at least, single indicator model that perfectly predicts the markets. If there were, everybody would use it. That said, if you were only going to have one category of indicators as a, let's say, trader, if you will, trader to short term to maybe intermediate term investor, I think sentiment, those that fall under the category of sentiment, are the ones to look at. And what they had a few different ones at various firms on Wall Street, including B of A, but one was based on where individual investors are, to Aaron's point. Another was based on institutional, and yet another one was this sell side indicator, which is based on what the Wall Street firms themselves were saying. And you almost had a universal conclusion: the more bullish all of those categories are, whether it's individuals, institutions, or those that are in theory supposed to know, the more optimistic they all are, it's a good time to go the other way and be a little contrarian. So not saying to run and hide, it's just one indicator, but there's a lot of optimism out there, and where there's optimism, there's often been a decent amount of risk as well.
All right, so if you'll allow me, hoagie review number 2 now.
Hoagie review number 2, let's hear it.
All right, so hopefully everyone listened to the first one. If you haven't, please go listen. And I think you will know from hoagie review number 1 of Lee's, it's not just the hoagie that matters. It's the experience, the vibe, the authenticity, the fixins that go on top, that all matter to me. And that is what drives this review. So this week we're going to talk about primos, not up and down the entire East Coast, but, from Philadelphia. There must be 100 of them all over the place. And I feel like this one's polarizing. A lot of people love it. Today we're talking about, the turkey Italian. We're not going the cutlet sandwiches and the bada bings. They got some great stuff. And meatball. So the bada bing is one of them.
The bada bing.
Yeah.
Right.
Anyway, so I think the hoagie itself is a good hoagie. However, I think they've lost themselves. 100 franchises or however they're structured in. Here are a few reasons. Number 1, I mentioned hot peppers in the last one about Lee's, how you can just eat it on its own. Here, you ask for hot peppers, you're getting those yellow banana peppers that you get at Subway. That's not authentic. I mean, you can't be an authentic hoagie place with banana peppers. That drives me nuts. Number 2, the oil and vinegar, as I referenced last time. There's no seasoning. There's no mixing. There's no finesses. They just got a basic oil, basic vinegar. It's fine, right? Now, this one didn't matter so much to me, but Michelle here in the office referenced this. They have a good seeded roll. I actually think the roll is a little too hearty, a lot of bread. Some people like it. Some people don't. Not my favorite. Sorry. Getting choked up thinking about this. Michelle says, you can get a smaller version of the hoagie. Well, the smaller version of the hoagie, they don't allow you to get a seeded roll. You only have to get the nut. Why not? I know you have to cut off a little bit and give the person the seeded roll, and you cut off a little bit and throw it out. But another thing that just drives the people mad. So the hoagie in and of itself, if you gave it to me and you blindfolded me, I think it's a decent hoagie. I think it's fine. A little too much bread, a little too crusty. It's not the best seasonings and this and that. But when you factor it all together, it is not an ideal experience. Again, the hoagie is adequate. Hoagie is adequate, but the overall experience is lacking, and that is why Primos. And then I'm not just identifying like I did with Lee's. One Lee is all Primos. 6.3. 6.3 on the scale. And I hope next week we find a better one, but that's where we are with Primos.
And what I like about that review is not only did you take some shots at Primos with a thorough and good review, you took sort of a broadside at Subway while you were doing it, which sort of a 2-for-1.
I'm not going to waste my time with a Subway review. Please. Yeah, so we got that out of the way there. Yeah.
All right. Good work. We'll have to, I guess, as they say in our business, we'll have to go with a more bespoke one next time. We'll get away from the local chains.
That's right.
Go to
I didn't want to go with another one.
Yeah.
I didn't want to go with another one that I liked a lot after last time, which Lee's I love. So, I want to have some variation here and keeping everybody on their toes. I'll tell you where to avoid as much as where to go.
You're taking out the big hoagie enterprises first, and then you'll get down to the more bespoke places.
Aaron Marks takes on Big Hoagie. So, I like it. So another thing we did last time, and I wasn't intending on making this a regular feature, but I figured I'd just throw it out there, is that I randomly give you to an over-under or something like that. Last time we hit politics. This time let's go to sports. So we are maybe 10, 12 days out from opening day of baseball. So, and I have no idea where the Vegas lines are. I'm not a big sports gambler, or frankly, I'm, I guess, a non-existent sports gambler in that I don't do it. But I'll just throw it out there. Pat, I believe you're a Yankees fan. Is that right?
That's right.
All right. So I'll give you both the same number. Over under 90 wins. Phillies, Yankees for the upcoming season.
Wait, will each of them, that's their over under 90?
Yeah.
Well, on the Yankees, Garrett Cole being out is not going to help things. Now, he might be back in a couple months. I think you could sometimes get a little bit of a rallying around when somebody goes out like that. And the Yankees do have some young guys that I'm waffling on this one. I want to say over, but I think I'm going to actually go under on the Yankees. And on the Phillies, my hometown favorite, I think everyone's pretty optimistic, but I think they've had a couple really good years recently. And I think everyone always, with everything, this person's going to have a great year. No one ever calls for somebody to have a bad year. It's easy for everybody to call for the good year. I just think it'll be just a little bit of a letdown. I hope Trey Turner really has a bounce back year. Like, we're only at March 19th today, but Bryce Harper's back is hurting a bit. Aaron Nola and Zach Wheeler, we signed to these good contracts, but they're creeping up there in age. So I'm going to go under as well. Unfortunately, I hope I'm wrong.
I like your mean reversion logic there, because I think that is often what most sports, analysts miss. They sort of just assume like blanket good stuff. In the same theme, I'm going to say Yankees go over as a result of that, since they underperformed last year. It's a high pressure market. They do have some good young players that I think will step in. And I agree that I think with the injury that they are facing early on, it could be a bit of a rallying cry, and they could I'm hoping they get off to a hot start and they can carry that through a little bit. So I'll go over there. On the Phillies, I'll go under 2, just based on the same logic you just gave. Although I think on paper they really should be far over that if they play to their potential based on what they've got on the roster.
Matt?
So I was trying to see if I could get the actual over-under line instead of my just made-up 90 here, but I wasn't fast enough. See, I don't even know what websites to go to in the sports gambling world. So, but I do like both of your contrarian views, sort of almost like the market sentiment indicator we were talking about. The Phillies have a lot of positive buzz around them, and I was very tempted to take the under. But I just think they're really good, and I think I am not that impressed overall with their division. Obviously, Atlanta's good, and who knows what the Mets are, but like I'm not that impressed with the division. So I will take the over with the Phillies. Yankees, it's almost the same logic, but in the other direction. Their division's just too loaded, and to me, to go over 90 in that division, you have to be both awesome and healthy, and they're already not healthy. So I'll take the under on the Yankees.
Let me give you one trivia question from a good friend and client of ours. We're talking about the Phillies and the Yankees, so it's a little bit of a tip here or a hint. Who is the current active leader in home runs in Major League Baseball? So active player with the most home runs. Putting you on the spot here.
Active player.
Did Pujols retire?
Pujols is done.
Oh, okay.
Talking about coaching, actually.
I didn't know if he was still lingering on a roster.
It's a Yankee. It's a Yankee.
Oh, it is a Yankee. Can't be Judge.
Giancarlo. Right? Don't call me Mike Stanton. Sorry, Matt.
I was just going to say that. I was literally just going to say Judge isn't old enough. Let's go with Stanton.
Unbelievable. I mean, with all the injuries, Stanton in order. Stanton, Trout, Votto's playing again, Longoria, Goldschmidt, Arenado, Freddie Freeman, JD Martinez. That's what I see on the list.
Longoria is that high on that list?
Unbelievable, right?
I know he's been playing like since the beginning of time, but I don't think of him in the same context as those other guys.
Yeah, I hope Mike Trout really has a bounce back year.
Yes,
that would be nice. I root for him. Yeah,
nice. Yeah. He's a Jersey guy, Pat.
He's a Jersey guy. Yeah,
he's a South Jersey guy though.
Sorry.
So our final segment here. Anything that you are reading, watching, so on that is of interest right now.
I just last night finished Masters of the Air, Tom Hanks, Steven Spielberg mini series on Apple. In the same vein of Band of Brothers and the Pacific, which I've not watched, but I really liked it. A lot of different storylines, which a cousin of mine mentioned. It sort of gets a little bit hard to follow, and like, where'd that guy go, and what happened to that storyline? But it's great storytelling, great visuals, with the air battles and all the airplanes and everything. But yeah, a lot of it hits home, and all the stuff that goes on in the world today. I mean, that was what our world was not long ago, and it was just a mess, and just the devastation all over the place, and families torn apart, and countries. It's wild to really think about when you try to put yourself in those shoes, which I cannot. But it was pretty good.
I started the first episode of that. I need to get back onto it. I've been on like a ridiculous, like sort of by accident World War II kick, so might as well just keep anything war related going. But I watched, Matt will love this. I watched American Conspiracy: The Octopus Murders on Netflix.
Oh, I watched that one.
Yeah, I liked it. As this is why I said Matt will love it, because we kind of have a joke that I'm the conspiracy guy in the office. Maybe I am. All that stuff fascinates me. If you call me a conspiracy guy or not, I just think anything about like our intelligence agencies is like objectively fascinating. They're like secret organizations, and they're very, opaque. And anytime you get stories, whether they're conspiratorial or true, I think it's interesting, because it's like, wow, I had no idea that crazy stuff happens. It makes you think about things a little bit.
Yeah. So, I mean, I think with conspiracy theories, if there's been, let's say, a more innocuous tragedy of the last few years with all these more extreme, let's say, detrimental and harmful conspiracy theories out there, is the good old fashioned conspiracy theory has gotten a bad name. I used to like conspiracy theories, but now it's like there are too many dangerous ones out there. I sort of stay away from it. I will say on that show, I did watch it, and I thought the story itself was fascinating. But I thought they sort of missed the mark on the show. Like it was hard to follow. It was almost like, you have really good content here. You got to do better with this.
I agree. I think they did botch, and they didn't stick the landing either. Like, it felt like they didn't wrap it up well. I still had a lot of questions at the end. One other thing I am I just started last night. I'm very excited about because it's gotten good reviews. 9.2 out of 10 on IMDb, which is like my that's like my Bible when I'm looking at, like if the ratings are good or not. Shogun. It's on Hulu.
I've heard
I
it
think
was
it's an FX
awesome.
show. So I
A
just started
lot of
that
people
last
are
night.
raving about it. I haven't seen it, but I know some people whose opinion I highly regard say it's awesome.
Nice.
I feel like
So
it's going to be really intense, and I need to prepare myself.
that's what I
Sometimes
did
at
last
night, I
night.
just want to watch something and zone out, but I
Yeah.
feel like I've got to be prepared
Yeah,
for Shogun.
understandable. Well, and there's subtitles too, so it's true.
Oh, a
You
lot of
gotta,
effort. A lot
yeah,
of
a lot
effort.
of effort. Yep. So
It's worth it though. Sometimes you get it. Look, Masters of the Air was not, a walk in the park, but maybe I'll take a breather after this one and then go to Shogun.
And well, I'll go with a book because I actually started reading again. It's been a few months, but I needed something that was just a fast read to like get me back in the habit of reading. So I read the memoir of Rex Chapman. Speaking of March Madness. And it's actually ghost written with Seth Davis, the NCAA commentator and reporter. But Rex Chapman's had a fascinating life, not always a pleasant life, but was a more or less the most highly touted college basketball player in the country. Left early for the NBA before that was fashionable. Had a lot of injuries, and then addiction and recovery and a lot of racial undertones, political undertones. It's an interesting life that he's had, and it was a fast read and an interesting book. So if you're looking for something that you can read pretty quickly that will keep you intrigued, I recommend it.
I haven't heard that name in a while.
good rec.
Yep. All right. Well, with that, we will wrap up episode 17. I'm pretty sure we're set up episode 18. We have an outside guest from outside the financial industry coming on to talk about a couple things.
Thanks, everybody.
Awesome.
Appreciate your time as always.
Talk to you soon.
Thanks, guys.